Welcome to Breaking News to Trading Moves. Imagine running a business where, well, the more panicked your customers get, the more money you make.
Yeah, it's a pretty good place to be.
Right, and that is exactly the reality for the world's largest financial institutions right now. We saw it play out this quarter. So our mission today is very clear. We are looking directly at the headline numbers from Bank of America's first quarter earnings report.
Which were, they were very telling.
Exactly. And we are categorizing the market into specific winners and losers
Yeah.
based purely on those facts. So let's lay out the core data right away. Profit rose nearly 17% to $8.6 billion.
Right.
Equities trading hit an absolute record. Investment banking fees rose 21%, and net interest income climbed 9%.
And, you have to look at what management highlighted, too. They pointed to healthy client activity, solid consumer spending, and stable asset quality.
Yeah, so those are robust material numbers across the board. They paint a picture of a financial system processing a very high volume of activity.
And what really stands out to me is the composition of that revenue. It is not just one division carrying the weight, It is a coordinated performance across multiple business lines.
Right. I look at a universal bank, kind of like a multi-tool. You have the consumer lending blade, the wealth management screwdriver, the traditional corporate loan pliers.
Yeah, all very useful for just daily operations.
Exactly. But when market volatility hits, that trading mechanism flips out and does the heavy lifting. We need to walk through the mechanics here for us.
Sure.
How exactly does market volatility directly fuel sales and trading revenues? Because for Bank of America, those revenues rose 13% to $6.4 billion.
Well, it really comes down to the role of a market maker. A universal bank is not necessarily betting its own capital on whether the stock market will go up or down.
Right, they aren't just gambling.
Exactly. Instead, they operate the toll booth. Think about a completely calm market environment. Trading volumes are low, and the spread between the buy price and the sell price, the bid-ask spread, is very tight.
So a stock might have a bid of $10 and an ask of $10.01.
Right. The toll booth is only collecting a single penny from a relatively small number of cars passing through.
But volatility completely changes that traffic pattern.
Precisely. When volatility spikes, you have institutions, pension funds, and asset managers all rushing to adjust their portfolios simultaneously.
Oh, so everyone is trying to fit through the toll booth at once.
Yes, exactly. A pension fund might decide they need to dump millions of shares of a tech stock, while a hedge fund decides that drop is a buying opportunity. The volume of traffic rushing through just skyrockets.
Oh, okay.
But here is the critical part. Because the environment is riskier and prices are swinging wildly, the bank widens that bid-ask spread to protect itself from holding a falling asset.
So suddenly, instead of a 1-cent spread, it's a 5-cent or 10-cent spread.
Yes. So now you have exponentially more volume, and the bank is capturing a wider margin on every single transaction that crosses their desk.
And they're processing thousands of these trades a second.
Right. That mathematical reality, wider spreads multiplied by exploding volume, is what drives a 13% rise to $6.4 billion in trading revenue.
Because it is a volume and margin business, and volatility provides both.
You hit the nail on the head.
Okay, so if volatility is the fuel for this specific business model, let's transition to the group of companies positioned to benefit from this exact environment.
The winners.
Right. First on our list of winners, the large money center banks. Bank of America's results act as a positive read-through for other large diversified peers.
Absolutely.
The specific names we are watching here are BAC, JPM, and C. And it is also crucial to note that JPMorgan beat estimates as well.
Right, which proves this strength is an industry-wide condition, not an isolated victory for one management team.
Why is that confirmation across multiple institutions so vital for pricing the sector?
Well, because these banks all share similar operational structures. They combine retail banking, corporate lending, and large capital markets divisions.
So success at one signals health at the others.
Exactly. The fact that trading conditions are strong, deal-making is better, and net interest income remains resilient means the underlying engine of the global financial system is running hot right now.
They all have that multi-tool you mentioned, and they are all deploying it effectively.
Yeah, they really are.
Which brings us directly to our next group of winners, the capital markets brokers. Bank of America saw a 21% rise in investment banking fees.
That's a robust increase.
It is, and we can link that straight to the broader advisory and underwriting ecosystem. The specific names here are GS, MS, and SCHW.
Right.
My question is about the timing, though. Why does a stronger mergers and acquisitions and capital raising environment create such a potent setup for these advisory firms right now?
To understand the timing, we have to look at what these investment banks actually sell and, well, why nobody was buying it recently.
Okay.
They sell advice and access to capital. For the last couple of years, corporate executives have been very hesitant to buy other companies or issue new stock.
Because the economic outlook was too murky?
Exactly. You had inflation fears, rate hike cycles, and recession predictions. The pipeline of deals essentially froze solid.
I mean, no board of directors wants to approve a large acquisition if they think the economy is going to contract and ruin the integration.
Right. You don't buy a competitor if you think you're both going to be fighting for survival in 6 months.
Exactly. So what changed?
Well, a 21% jump in investment banking fees tells us the ice is finally thawing. Corporate executives are gaining the confidence to strike deals again.
Oh, so if a major pharmaceutical company decides to acquire a biotech rival, they do not just shake hands.
Exactly. They hire an advisory firm to value the target, negotiate the terms, and structure the transaction. And the firm collects a substantial fee for that service.
What do they need to borrow money to make that purchase?
Then the investment bank acts as the underwriter. They will structure the bond offering, go out to their network of institutional clients, and sell those bonds.
And raise the billions of dollars needed.
Right, taking a percentage of the capital raised. As this environment gains momentum, firms dedicated heavily to this specific flow see their revenues multiply rapidly.
Got it. Okay, let's move to the third group of winners. Consumer finance. Management reported solid consumer spending and stable asset quality.
Yes, they did.
So we are connecting that to lenders and card companies. The specific names here are COF, AXP, and USB. But wait, I need to stop you here and push back a bit.
Okay, go ahead.
For months, all we have heard is that the average consumer is tapped out. We hear about depleted savings accounts and inflation destroying purchasing power.
That has been the dominant narrative, yes.
So if the market generally feared consumer weakness, how does this specific confirmation of contained credit trends alter sentiment for these specific consumer finance names?
I understand the skepticism. It gets to the core of how financial markets actually price risk. The stock market is a forward-looking mechanism.
It doesn't price in what is happening today.
Right. It prices in what it thinks will happen 6 to 9 months from now. Over the past few quarters, analysts looked at rising interest rates and inflation and, well, assumed the average consumer was going to buckle.
They modeled a disaster.
Exactly. They modeled a rapid increase in net charge-offs. They assumed people would max out their cards to buy groceries and simply stop paying the bills entirely.
Wow.
And because of that widespread fear, the market aggressively discounted the stock prices of consumer finance companies. They priced in a worst-case scenario.
So defaults would wipe out profits, which means the bar for success was set incredibly low.
Yes, the bar was on the floor. However, the data we are reviewing today shows something entirely different than those disaster models.
Consumer spending remains solid. People are still swiping their cards.
And more importantly, asset quality stayed stable. That means the loans on the books are performing better than expected.
So when reality proves that credit trends remain contained, that worst-case scenario is forcefully taken off the table.
Exactly. Investors are forced to re-rate these stocks higher. They aren't buying because the consumer is invincible.
They are buying because the disaster they anticipated didn't actually materialize.
You've got it.
Okay, that makes sense. It's a relief rally driven by facts, beating pessimistic expectations. Having established that scale and capital markets exposure are the winning traits this quarter.
Let's look at the other side of the ledger.
Yes, let's transition. We're moving to the segments of the market that either lack that scale or find themselves facing increased competition from the giants.
The losers in this environment.
Right. Let's start with regional and less diversified banks. The names in this category are FITB, PNC, and KEY.
Right, the regionals.
Why are they struggling while the money center banks thrive?
This is where we see a distinct structural disadvantage. These regional banks operate on a much more traditional model.
So they take in local deposits and lend them out as mortgages, auto loans, or small business loans.
Exactly. They make their money primarily on the net interest margin, the spread between what they pay depositors for their cash and what they charge borrowers for loans.
And right now, that spread is under pressure.
Severe pressure, yeah. Depositors are demanding higher yields on their savings accounts, or they will just move their cash into a money market fund.
So the regional banks have to pay more to keep their funding.
Right. Meanwhile, loan demand is somewhat muted because borrowing costs are high.
And as we discussed earlier, they do not have that multi-tool to fall back on.
They completely lack it. They do not have active equities, trading desks capturing market volatility. They do not have global mergers and acquisitions teams generating advisory fees.
So in a quarter where those specific capital markets activities are driving the majority of the profit beats.
The regionals are simply left behind. They cannot capture the earnings tailwind that Bank of America experienced.
This quarter really highlights a widening perceived gap between the largest banks and the rest of the sector.
It absolutely does. The giants have multiple levers to pull to generate revenue. The regionals are confined to a very specific and currently challenging lending environment.
That brings us to the next group on the losers list, which falls under defensive bond proxy sectors. The names to watch here are DUKSO and KMB.
The classic defensives.
Right. I want to ask you about the mechanics of risk appetite. If strong bank earnings improve risk appetite, how does money physically rotate out of these purely defensive value trades and back into financials and cyclical names?
It is entirely about capital allocation mandates and, the physical constraints of institutional investing.
Okay, break that down for us.
While institutional investors, like mutual fund managers, have a set amount of capital they must keep deployed in the market. They cannot just sell everything and sit in cash.
So during periods of heavy economic uncertainty, they move that capital into safe, reliable companies to weather the storm.
Exactly. Utility companies and consumer staples are classic examples. I mean, people still pay their electric bills and buy toilet paper during a recession.
And these stocks often pay steady dividends, acting almost like bonds, which is why we call them bond proxies.
Right. Portfolio managers buy them for downside protection, knowing they won't get rapid growth. They are hiding out in a safe harbor.
But risk appetite is a pendulum.
It is. When an earnings report like this comes out showing healthy consumer spending, stable credit, and booming capital markets, the perceived risk in the overall economy drops.
So those portfolio managers look at their screens and realize their capital is sitting in slow-growing utility stocks.
Yeah, while financial and cyclical companies are accelerating past them.
And they are judged on their performance against a benchmark they can't afford to lag.
Right. To capture that growth and keep up with the market, they must physically sell their shares of the defensive companies to free up the cash required to buy the bank stocks.
Oh, so that coordinated selling pressure driven by thousands of portfolio managers making the same calculation is what causes defensive sectors to lose momentum.
Exactly. The capital is literally flowing out of Duke Energy and into JPMorgan.
Wow, okay. That brings us to our final group of losers. And this might be the most complex dynamic we cover today. Alternative asset managers.
Yes, this is a crucial one.
The specific names here are BX, KKR, and APO. Let's lay out the facts on the table. Bank of America is building a $25 billion war chest specifically for private credit.
Right.
Meanwhile, the wider $1.8 trillion private credit market faces increased scrutiny, tech-heavy portfolio risk, fund outflows, and fears of credit stress.
It's a tough setup.
It really is. So how does aggressive expansion by traditional banks put pressure on these private credit specialists?
Well, to fully grasp the stakes here, we have to look at how this $1.8 trillion private credit market evolved in the first place.
Right. Where did it come from?
After the financial crisis of 2008, regulators forced traditional banks to step away from riskier corporate lending. They wanted to de-risk the banking system.
And alternative asset managers happily stepped in to fill that void.
Exactly. They started lending directly to companies and keeping the loans on their own books rather than syndicating them out to the public bond markets.
So over the last decade and a half, they built a prominent business model, largely free from traditional bank competition.
Right. They had a monopoly on a specific type of high-yield lending. But now, Bank of America is marching into their territory with $25 billion ready to deploy.
And that alters the entire landscape of the industry.
It absolutely does. Traditional banks have a lower cost of capital than alternative asset managers. Their funding comes from sticky retail deposits, which are, relatively cheap.
Whereas private credit firms get their capital from institutional investors who demand high returns.
Exactly. So, if a mid-sized company needs a loan, and Bank of America is suddenly bidding against a private credit firm,
the traditional bank can afford to offer slightly better terms to the borrower.
Right, so the private credit firm is backed into a corner. They either have to lower their interest rate, which hurts their returns to their investors, or they walk away from the deal entirely and lose the business.
It is a total margin squeeze.
It is. And furthermore, these alternative managers are dealing with internal pressures simultaneously. Many of these private credit portfolios are heavily concentrated in the technology sector.
Right, startups, software companies, and tech firms relied heavily on this type of bespoke financing over the last few years when money was cheap.
And now money is not cheap. Higher interest rates put immense pressure on tech valuations and cash flows.
So, a software company that looked like a safe bet at 0% interest rates might be struggling to make loan payments at current rates.
Exactly. This creates real fears of credit stress within those specific portfolios. When investors see that tech-heavy risk combined with actual fund outflows, they get nervous.
Add in a giant like Bank of America aggressively attacking their core business model, and the sentiment around alternative asset managers becomes decidedly cautious.
The competition for yield is becoming fierce, and the traditional banks are bringing substantial resources to the table.
So let's boil down what we've covered today. The cleanest bullish read from this earnings data is for large U.S. banks with strong trading and advisory franchises. They are capturing the volatility and the return of deal making.
Absolutely.
And the most cautious angle surrounds private credit specialists facing rising competition from traditional banks and ongoing credit quality scrutiny.
Right. The facts presented in this report clearly indicate that the infrastructure of capital markets is highly active.
Ultimately, today's price action depends entirely on whether Wall Street revenue engines are stronger than the market expected.
Volatility and deal flow are providing the fuel, and the largest institutions are capturing the upside.
Exactly. So we want to leave you with a closing question to ponder.
It's a good one.
With traditional banking giants bringing massive new war chests into the 1.8 trillion private credit space, where must alternative asset managers look next to maintain their competitive edge in yield?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.